Joining us now is a great friend of the show, Rory Johnson. He's the founder of Commodity Context, a fantastic Substack, which we'll have a link down in the description. Thanks for joining us again, Rory. We appreciate your time.
Thanks for having me this morning.
So you were reposted by the President of the United States, seemingly bragging about policy. Maybe we can turn the tables here a little bit. We'll see if he'll repost this segment. The President announcing a full naval blockade of Iran. Let's put this up here on the screen, effectively announcing that they will not allow any vessel to enter an Iranian port. So CENTCOM clarifying this morning that any vessel that is headed for Iran is subject to, and I want to get this language correct, interception, diversion, and capture, literally any vessel, not just an Iranian vessel. So, Rory, you're our resident oil analyst. What does this mean for the global oil markets?
Yeah, so for context here, one of the things that I think is important to keep in mind, and one of the weird things about this crisis thus far, is that if you had asked any oil analyst, myself included, 3 months ago, if Iran was going to close the Strait of Hormuz, would Iran still be exporting oil? And the answer would have been obviously no, right? That would have been something that obviously in such a situation, the United States or whatever kind of opposing party would have blockaded those shipments. And the strange thing is that throughout the crisis, Iran has continued to export its oil. Not only export its oil, but at higher prices and thanks to U.S. Treasury sanctions repeal to more and more consumers at lower and lower discounts. So they've actually been making kind of great money out of this process thus far. And one of the things, and now Trump is trying to remediate that and saying, okay, now we're going to cut off the flow of oil after 6 weeks. So I think the question here now is, the first Iranian tanker or the first Iranian ship, either direction, to test this blockade is going to set up this next step for escalation, because thus far Iran has generally withheld or held back from attacking production assets across the Middle East or export and loading infrastructure. If they now can't export their oil, maybe that's the next thing up for grabs. Should, let's say, the United States fire on or seize an Iranian tanker.
Let me go ahead and put, guys, C7 up on the screen. I wanted to get your reaction to this. And this was written up by DropSite from publicly available information. They say Iran has about 174 million barrels of oil in floating storage that a blockade would not touch. And you can see all of the details there. They say over 90% is bound for China, carried largely by Ghost Fleet tankers running dark. 129 tankers linked to Iranian crude currently sailing dark, according to Windward. U.S. naval blockade of Iranian ports won't intercept oil that is already at sea. And then it goes through a list of where these tankers are located. How does this factor into your calculation? Because it seems that Iran has somewhat prepared for a scenario similar to this.
That's exactly right. And I follow a group called Tanker Trackers. And what they've noted for a couple of days now is that if this should happen, Iran has basically positioned a large kind of flotilla of floating storage just outside the Gulf of Oman, specifically that would allow it to continue servicing these clients, at least for some time, should the actual strait be blockaded. Now, obviously, the United States Navy is quite sophisticated, quite large, and quite capable. We saw this during January of this past year, or earlier this year. Time flies. But when they were kind of blockading Venezuelan exports and chasing down Venezuelan tankers across the Atlantic, clearly it's a question of how intense they're planning on enforcing this. They're able to, again, but this question of, is this just the latest kind of jawboning or kind of, threat from Trump, or are they actually going to follow through with this? At this stage, 6 weeks into the war, it's very, very difficult to kind of handicap that, because, it seems like yes, but who knows? We could be an hour away from Trump, posting that peace has been found in the Middle East and oil is going to drop another kind of $15 a barrel. And this is the challenge we face: is no one actually knows what's going to happen next. All the while, 13 million barrels a day of production remains shut in the Gulf, and the world hemorrhages that volume of crude every day the strait remains closed. And thus far, the strait is not only closed, but now it's even more closed than it was at the beginning of the weekend.
Yes, that's what I wanted to focus on with you, is you were warning to us a couple of weeks ago, if we're in this scenario, the amount of destruction just inevitably will lead to demand destruction. Now, the strait, like you said, is not just closed, it's even more closed. If we take some Iranian oil offline and there's not any Persian Gulf oil that continues to move through, let's put the market just on our side, because maybe they will catch up to supply. Supply-wise, what are we talking about? Are all the shortage conversations, jet fuel, et cetera, is that back on now? Is that still a reality? Like, what's that going to start to look like?
It's not only still on it never changed, right? I think that's the issue, is that right now, so again, just for context, roughly of the 20 million barrels a day of previous flow that was traveling through Hormuz every day, roughly 7 million barrels of that has been offset by rerouting. The Saudi East-West pipeline, kind of Iran's flow continuing, et cetera, et cetera. But that means 13 million barrels can't exit the Gulf and has been forcibly shut in. That's the barrels that we're losing kind of every single day. And right now, thus far in the crisis, we've lost roughly more than 400 million barrels that were going to be produced this year that now just aren't. The longer this goes on, you quickly approach 1 billion barrels, particularly with the necessary ramp back up. So yeah, this is going to continue. The longer this goes on, you're going to need to fill that hole, because 13 million barrels a day, now 15 actually, if you block Iranian flow, because that was one of the offsets previously. So 15 million barrels a day. There's no supply source in the world that can fill that. So if the strait remains closed, if this is, again, a month or two more of what we're talking about, you're going to need to see prices skyrocket in order to forcibly destroy demand. We're already beginning to see shortages across a bunch of different regions of the world. Asian airlines are canceling flights. You've seen talk of rationing jet fuel in southern Italy. The EU broadly, European jet fuel suppliers have basically said that they can't commit to supply jet fuel into May. That probably through April, this is going to be good. Like there's buffer here. This is what the inventories are for. But as we get into May, and again into kind of peak travel season, June and July, that's when these suppliers can no longer guarantee shipments, which means that airlines that are trying to book flights, or trying to plan flights, are not going to be able to. I have a bunch of friends that are trying to plan European vacations, and they're like, Rory, will we have jet fuel? Will there be flights to get back? And I'm like, I don't know, right? And you never would have pictured a moment where I'm like, I don't know if Europe would have jet fuel. That's the kind of situation we're now in right now.
Yeah, absolutely. Well, it's 9:10 a.m. right now. I'm looking at the oil prices, just above $100 a barrel. What's your sense of whether that reflects reality, or whether these markets are still somewhat delusional, or pricing in, okay, we expect Trump to somehow magically resolve this in the next short period?
I would say definitely. I don't know if I would go so far as delusional, but certainly sanguine, overly optimistic relative to where I see the situation now. One thing that's kind of been a hallmark of this crisis throughout, given this kind of chronic expectation, this persistent expectation that this will end any day now, and that flow through the Strait of Hormuz will resume tomorrow, is that most of the kind of pricing pain, the pricing pressure, is being felt at the very, very front of the curve, in what we call like extreme backwardation or term structure at the front of the curve, the shape of the futures curve. And that extends into the physical and spot market. So right now, even though Brent crude right now is trading at just over $100 a barrel for June delivery futures, WTI, which is trading in for May, is actually trading at a premium to that, which is weird at the front of the curve. And dated Brent, which is the spot benchmark, is trading north of 130, and then the physical delivery of these various actual crude cargoes is something at $20, $25 at a premium to dated Brent. So many of these physical crudes are trading at over $150 delivered.
Wow.
And that's the kind of thing that eventually futures need to recognize that. But thus far, the White House has been very successful in kind of managing expectations that this conflict is going to end any moment. And who's to blame traders that can't get too long, because then they're going to get blown out of their positions with a $15 a barrel tweet. It's a very strange market to trade.
Rory, can you just transfer some of that into gas prices? What is that? So let's say if we caught up, what did you say, 150 a barrel? What does that look like at the pump nationally for the U.S.?
Well, what's interesting actually is that physically, U.S. consumers are basically going to be paying spot prices for gasoline. So they actually will be paying these prices rather than June delivery, right? We all consume in physical spot markets, even though the futures price is trying to continue to handicap this forward. So yeah, you're going to see national average prices at this pace easily outstrip $5 a gallon, en route to $6 a gallon should this continue by June easily. And I think that's just gasoline. Diesel at this stage is trading at a decent premium to that. So you're going to see you've already seen kind of all-time highs reached in California. You're going to see that across the entire continental United States.
Wow. Yeah, where this morning it looks like $4.13 is the national average per AAA. And I wanted to talk to you, obviously you focus on oil, but I'm sure you've thought quite a lot about the way this ripples throughout the economy. Let's put C5 up on the screen. This was some reporting from the Wall Street Journal about the warnings that the Trump White House is fielding about the Iran war's economic hit. Some of these warnings coming from oil executives. And we can put C6 up on the screen as well. We had a relatively hot inflation report. Last Friday, U.S. inflation tripled last month based on a record spike in gas prices. Obviously, you know, it's not just at the pump where we feel the increase of these prices. This flows throughout the entire economy. So talk to us a little bit about what you expect there.
Yeah, so consumers are going to feel this primarily through gasoline pump prices, but the kind of stealthier way that this is going to, continue to juice inflation is through diesel, is through jet fuel, is through these fuels that kind of, these middle distillates, diesel and gasoline in particular, are effectively the fuels that drive the industrial economy. These are the prices that, unless you have like a diesel Hemi truck, you might not be paying for diesel at the pump, but you're going to start paying, surcharges on Amazon deliveries. You started to see flights that started charging surcharges on, long haul flights. All of these things are going to begin to be incorporated, because otherwise, corporate margins are going to get obliterated. And I think the longer this goes on, the more this is going to go from special surcharges to just new high prices. And that's the thing we saw through 2022, is the longer this goes on, that's when those inflationary expectations begin to mount. And that's when you begin to see companies have more of this kind of space and kind of flexibility to raise prices, even if they would have hesitated historically. That also, I think, bears on central banks, and the fact that many central banks would have been wanting to be cutting interest rates during this period to kind of support the economy, which looks like it could be flagging in a couple different areas. That, I think, is also now going to be on hold, given the very recent experience in 2022 of runaway inflation and how unpopular that was for consumers. All of this, of course, is just deeply, deeply bizarre and ironic, coming from an administration that was brought into the White House to end forever wars in the Middle East and increase and kind of better the cost of living for American consumers. And so far, we're going in the polar opposite direction.
Last question for you, Rory. Our next segment is going to be about Asia. There's been significant unrest in these Asian countries over their reliance here on Iranian oil. The Korean president is openly feuding with the nation of Israel. He's obviously very upset. 50,000 Japanese people actually took to the streets a couple of days ago to protest the Iran war. This doesn't really happen all that often. So can you break down, we just talked here about the U.S. economies. The situation seems way more dire for them, where the vast majority of their oil comes through the Strait. What shortages and other prices can we see in the Asian economies in the coming months?
So everything that I was talking about for North America or Europe about jet fuel is kind of doubled or tripled for Asia.
Okay.
The vast majority of oil from the Strait of Hormuz goes to Asia. While not as much of, let's say, the direct diesel and jet fuel that goes to the European continent, the vast majority of the crude oil. So you've seen Asian refineries pull back their operations considerably, and you saw Asian or Singaporean jet fuel jump above $200 a barrel equivalent in the first week of this war, and that has continued to mount higher. You've seen the steepest service cuts to airlines, everything that's going to be coming across Asia, and you've also seen Asian economies coming out of the very recent experience of COVID, also being far heavier handed than kind of Western counterparts on forcible reductions in kind of policies meant to reduce mobility. So you've seen governments talking from work from home. You've already heard people talking about the odd even license plate days of who can drive into cities. And I think for a lot of these economies, you also see heavy government subsidies or kind of support in these prices, which if that level of support persists through a price shock, shifts this from a consumer shock to a fiscal shock, which kind of has all of these kind of government bankruptcy concerns that begin to mount. So at the same time, these consumers are used to very stable prices. And if this continues, you're going to need to see governments rapidly and kind of abruptly pull back support. So that price shock is going to be doubly painful for those consumers that are used to prices that really don't move around nearly as much as we see them at the pump.
Very true. Thank you for, sorry, go ahead.
Oh, I was just going to say thank you.
Yeah.
That's all. Thank you, Rory.
Thanks, guys.